Hello, everyone. It's Dr. K coming at you from London and Gil Morales from Playa. We're doing a weekend broadcast because apparently they had a technical failure on Friday, so I guess these things happen. It's good that it was the first time that sort of thing has happened. But at any rate, the markets continue to plug ahead. They were higher on lower volume, but the markets did like hearing Janet Yellen, the vice chair, echoing Bernanke's sentiment of easy money via quantitative easing. And as the economy, as it hasn't shown really convincing signs yet, but as the economy does start to strengthen, and I suppose there will be a point where that does occur, then the Fed's words will probably become less relaxed as they start to taper off QE in a slow manner, because they're looking for ultimately markets to adjust to any diminishing levels of QE going forward. And of course, right now, they know that markets are unsettled. When a couple of the Fed members said that they were going to slow or end QE prematurely, of course, the markets got knocked down. And Fed Bernanke to the rescue reassured markets that that's not going to happen. But it will ultimately happen once the economy starts to show signs that it's gaining a foothold. And you know, the idea that the Fed would just cut QE or just all of a sudden just seems nonsensical, because everyone's aware that that would be very unstable to markets and to the very fragile recovery that I don't even think we're really seeing much of a recovery, but let's call it the fragile recovery that we hope to see. Now, in terms of economic news, we know the employment report came in better than expected on both payroll data and the jobless rate. So as that jobless rate starts to get closer and closer to the Fed's mark of 6.5%, I would imagine that they would then start to ease off the accelerator. And over in European news, there was a downgrade. Fitch Ratings downgraded Italy's sovereign debt to BBB+, but this should come as no surprise to these struggling dominoes over here in Europe. Now, as far as the technical action, we're still seeing baby steps as QE pushes the markets higher. It was interesting that the markets had the price volume, perfect price volume action in basically from February 20th till February 25th, where you had enough distribution days and a breakdown in leadership, and you had all the signs of a market that looked to break down further. But QE is very powerful, and you don't want to fight the Fed, so you have to be nimble in these kinds of QE environments. So despite the model going to a sell, it recognized that these markets are stabilizing, and so it was quick to not just go to cash, but to go to a buy signal once again. And we could see this baby stepping pattern continue like we did in January of this year. We could also possibly see another type of scenario where we get a more aggressive move to the upside. But watching the leaders will tell us that'll be one of our guideposts going forward. But we just have to keep in mind that QE is alive and well, and it's firing on all fronts in the U.S., the U.K., and in Europe. Gil?
Yeah, I think the one thing to keep in mind about Friday's jobs number is that it's another manufactured decline in the unemployment rate, because you had 296,000 labor force participants leave the labor force. So basically people who were part of the labor force don't have a job but just gave up on looking for a job, so they've left the labor force. And in fact, the labor force as a percentage of the U.S. population has dropped to the lowest level since Obama came into office. So there's no real improvement, really, on the employment front. And I think the market, after looking a little wobbly on Friday, realized this. And the Fed also emphasized, I think Bernanke in his comments earlier in the week stated that the employment situation rather, is still a little bit dicey, and they're still cautious about that. And in fact, I don't really see anything improving in the economy, that's organic. I think there's some rotation around in some industries that are doing well, some that aren't, based on the overall macroeconomic situation and how consumers react to it, as well as businesses. So I think everybody's trying to save money, and the economy still remains a little bit soft, but that doesn't keep the market from going higher. And as I see it, we're probably just in another bubble. And the Fed with 0% interest rates, with massive government spending that just goes way off the charts, historically. You've just got this massive stimulus in there, and it hasn't gotten the economy going very much. You've had about 1.2% GDP growth in 2012, and of course we've seen pretty tepid numbers so far this year. So all of this massive stimulus in the form of monetary policy as well as fiscal policy and basically borrowing and spending, it's on a massive scale, and so it's still in the system. And if there was some sort of catalyst that allowed it to catch hold and create some traction in the market, you could just have this continuing bubble type of rally, but it can go on for a long time. I mean, 99 to 2000 was a bubble, but you made a lot of money in a very short period of time if you played it right. So I think that's what you need to be focused on in the price volume action. As Dr. K was talking about, you're making baby steps higher. You notice the NASDAQ Composite here. By the way, I'm using my HGS Investor software package today, which can be used for a variety of visual screenings of the market. If anybody was watching the screen before the webinar began, you may have noticed I had some ranking modules up. I'm just looking at different sectors and industries based on velocity, relative strength, and things like that. It gives you a nice visual picture of what's going on in the market. That's one of the things I like about it for, say, weekend work. And I think Dr. K and I will probably focus today's webinar on, or around rather, the context of what we do on the weekends. So you're looking at the NASDAQ Composite. You've been going higher on lighter volume. If you look at candlestick charts on these, I don't know if I got one handy, but if you look at a candlestick, say on the NASDAQ, it's a little bit of a hanging man type formation. I don't know if that tells you you're going to pull back, but you're at the top of this sort of big channel, and the market has tended to just chop its way higher. And as Dr. K said, you know, last week's action and the week before, and that looked very toppy. Now, something to keep in mind is that sometimes the market can continue going higher, but come under distribution, and you start to see some breaks on the way up, and maybe that's leading to a broader correction. But even if we had a correction, how deep would it go? We held a 50-day moving average on the NASDAQ the last time around. And so trying to get too bearish, I think you can get bearish on certain stocks at certain times, Apple being a notable example. But I think that you kind of can't be very rigid in this market, just kind of go with the flow, and that's the best approach. We can look at some other indexes here. I believe we have, let's see, where's the Dow? Let me go to the major market indexes. The Dow has been the leading index. Let's see, what's this thing going to do? Go to sleep on me here? There we go. And you can see it's been streaking to new highs, all-time highs, in fact. What I think is interesting, and let's look at, say, the S&P 500 there. So that's a little better there. Now let's look at a weekly chart. And if you look at the last couple of weeks where you had the sell-off, on a weekly chart, these actually look like supporting weeks. And I'm going to go to another group. Let's go to index components here. And I like to look at this S&P, where did it go? S&P 1500 index. It's a very broad market index, but I like this as a broader indication of what's going on. You see the same sort of thing on the weekly chart. You came down and tested the 10-week line. And this is the broader market, so not the S&P 500, but an S&P 1500. This is an HGS investor index that they created, which I like. But you can see you get some support off below. So the market's really telling on a weekly chart that it's getting support on a weekly basis. So the bids step in there and drive it higher. Now, one of the problems I think with the market this week is there weren't a lot of breakouts. I'm going to go to some of my buy lists here. We'll look at some of my stocks in here. There weren't very many breakouts at all during the week, and I don't know if that's necessarily problematic, but there wasn't a lot that was actionable. I mean, for example, whoops, Centaurus is acting very well, you know, after this Buyable gap up, so holding in very tight, volumes drying up a little bit. It may go sideways, but the Buyable gap up still seems to be in force. Now, an interesting question someone had for us. I think it's a good question, but it's not really something that we look at. And what they're asking is whether this is a, let's see here. Not sure why this program is stalling out. There we go. But here's they're talking about a long-term upper trend channel, and the stock breaks out of the top of the trend channel. My first response here would be that that's not really a rule that we follow. I think it's one of those labeling rules where they're trying to establish some sort of general label for a chart pattern, and that you do X based on the label that you can apply. And so in this case, if you can apply a label such that this thing's breaking out of the upside trend channel, then you should sell into that. And Dr. K, what is your initial response to a rule like this?
Well, generally speaking, I like to sell on weakness, not on strength. When you get first of all, you have a buyable gap up situation, or at least you have a nice gap up on a strong earnings report, and you'll notice that this stock has been pretty small. It's been a micro cap for a long time, trading in the single digits, and the earnings line has really started to move to the upside. So to me, in context of everything, this stock potentially has a lot more room to run to the upside. So to use a hard and fast rule to say, well, it's broken the upper channel trend line, so you should sell, is really ignoring the context of the situation, and everything has to be taken in proper context. I'd say I'm bullish on this one, even though it carries a lot of risk. It's a very volatile name, and it is still a small cap name. However, technically speaking, it looks quite bullish.
Yeah, I mean, we just go with the action, and I would say that if you start to rely on this need to label, and this is a concept we address in our most recent book, the need for labeling as a heuristic trading method, or as a heuristic rule, I guess. But let me just look at some examples of this that I think are flawed. If you say, for example, I'm just going to go back to a period. If I had been relying on a rule like this back in 2004, I would have dumped my Apple just as it started to rock and roll. And you can see here's Apple right here on a weekly chart, and this is when the move began back in 2004. I got on board right about in here on the stock, and then it really started to move. And if I had gotten on board here, I would have been selling into this on the basis of this this rule, because of course this is a trend line breakout, or a trend channel breakout. So it's a good way to sell stocks that are just about to take off. So I'm not sure if there's more to this. I would hope that there is. But just to apply a label to a pattern and say, oh, if you can apply label A, then do B, that's really too simplistic, and that's really at the heart of why we operate mostly according to pocket pivots, buyable gap ups, and standard base breakouts as well, along with the 7-week rule. And that's basically a very neat system that can work reasonably well. No system is going to be 100% perfect, but I think any rule that gets you out of a stock, just as it could be starting a monstrous move to the upside, is just wrong. So, that's as far as I'll go there, and that's just what we think about it. And there's no way we apply any of this rule at all, because it's really not necessary based on using the 7-week rule along with the various buy points that we'd like to use. So, what other stocks are looking good? I notice I run our friend Fred Richards over at stratinv.net. I believe he has a couple of screens he likes to run, like A190, so basically all stocks with an A accumulation rating and a total EPS and relative strength of 190 or better. So you're basically looking at 95 or better. There's only 13 stocks on that list right now, but the two that show up that we have positions in right now, not as big as they should be, but that's all based on hindsight investing, are Celgene, and the other one I'm sure everybody can guess is LinkedIn. And LinkedIn is acting pretty well. Volume's drawing up. It seems to me it needs to form some sort of at least a tight flag in here, so that's what I'd be watching for. After hours on Friday, there was a downgrade of the stock to hold from buy, which means people then sell it, I suppose. But I would love them to sell it down and see where it finds some support, because that could be a spot to at least give you reference as to where the stock's likely to pull back to in the process of building a flag formation. So you establish some lows there, and it comes down to the 10-day, and now you have a chance for another buy point coming out of this. But the bottom line is, the line of least resistance on this is likely broken here, and well, not likely, it is. And we can just bring it down a little bit. You can see this is the line of least resistance. Pretty simple concept. It's right along the 125 level and the highs of the IPO. And boom, you're off to the races. That's the first stage breakout. Now all you're left to doing is watching for the next stage base to form. And that's basically where you're at. I think LinkedIn is a lot like Netflix was in 2010 and into 2011, where you're going to hear a lot of valuation arguments against the stock, but it's just going to continue higher. I think though LinkedIn acts a lot more constructive. So, so far the stock's acting pretty well, and that's one of the top stocks in there that I like. I also think you should keep an eye on Splunk. It's going to turn the corner in earnings in the next year or so. But I've noticed a couple of things that catch my eye. There's a lot of smart institutions moving into the stock. Very, very nice pattern here. It's holding along the high. I think it's going to need more time to go sideways, I think. But one thing I like here in this stock is notice the average volume has moved higher, which tells you that more institutions are trafficking in the stock. That's one sign I used to tell you that a previously young, small stock that's relatively thin is starting to grow up as average volume increases. So something to keep an eye on. Splunk is a very forward-looking situation, but what I think they do, or I think that what they do adds value in a manner that's probably positive for any business that uses their services, and I think businesses in this environment are going to seek any edge they can in terms of their cost structure, and this may help in terms of being able to analyze their data. Anyways, other stocks that were looking good. What do you got, Dr. K? What other ideas have popped up?
Well, there's SLCA, the fracking company, and if the U.S. is going to come into a lot of oil, then certainly this will bode well for companies like U.S. Silica Holdings. The earnings slowed down in the most recent quarter, but if you look at earnings overall, they've been very robust. The sales have been strong. Institutional sponsorship, since they started tracking, has grown in every quarter, marking a total of 4 quarters. It's an IPO, and on the weekly chart, it looks to me like it wants to power ahead with its Buyable gap up as a result of its favorable earnings report. So I'm bullish on this one.
Yeah, you can see earnings growth turning around, sales growth, all moving pretty good. Estimates aren't so hot for silica, but I think the surprise here is that there may be a push towards more fracking. That's what they're into, and I noticed there's some confirmation. Continental Resources is just trying to break out of a cup with handle formation here. It's an oil company. But they do have a huge interest in the Bakken shale region, I believe, and it's breaking out right here. I mean, you can see here's a cup with a handle, and it's breaking out right now. I guess it's within buy range and maybe a little extended. But again, it is an oil stock, but you're going to see big earnings turn here. This is showing estimates. I believe they use Reuters estimates here, whereas I think O'Neill uses either their own or First Call. But still 46%, 77%. In the next quarter or the next 2 quarters. So you're seeing some acceleration here, and stock is starting to come out of this pattern. I know CLR has had big moves previously. I think it was a big winner back after it came public. I think it came public, it was in 2007, it had a huge move.
Yeah,
but that was
it had a huge move in 2008.
Yeah, and maybe it's setting up for another one, who knows. But it's in the right spot. And another one in the group that's been acting well is this Bonanza Creek Energy, which it kind of drives me nuts because you're looking for some kind of a base to form. You get some nice support here on the weekly chart off the 10-week line, and then it launches to highs. But it's a little bit of a squirrely stock, so you're kind of up there, but you might watch for some kind of a retest back to the top of the base or a pullback. That one surprised me. You get a little bit of a doji stalling up here, so it tends to be volatile, so I think you buy it on weakness. And, of course, I think the best place to buy it recently was probably coming off the 10-week moving average. You notice the breakout on the weekly chart, you don't get that much volume in here. Let's see my crosshairs. Anyways, I'd like to get to some questions because I'm sure that will lead us to a lot of the stocks that are acting well these days. Calm Vault is one I've been following. You're basically forming a base, so you're looking for a breakout at this point or some sort of a pocket pivot. If you're too far above the 10-day moving average, this is a daily chart, by the way, you're too far above the 10-day moving average to have a pocket pivot, but I guess you could just have a standard issue breakout. On a weekly chart, the stock looks okay. Take a look here. Nice and tight. Some tight closes, some supporting weeks in here. drawing up on the pullback, but no real big volume on the upside. But it looks to me like it could be getting ready to break out again. This is one of those stocks that's baby step and stair stepped its way higher. I remember O'Neill telling me about stocks like this, that they'll do this and they'll bore you to tears, and all of a sudden they'll go into a parabolic move, and that's where you make the real money. So keep an eye on this one, definitely. Proto PRLB, let's go here. This thing just straight down, straight back up. I think it's building a base. It is somewhat extended. You had a nice breakout in here, pull back to the top. Kind of a weird pattern. It's hard to figure out what this is, and so it'd be difficult to buy unless you are focusing on buyable gap ups, which it failed on this. So, that's how this stock is. Very thin stock. I think it's trading about 500,000 a day, somewhere around there. So it's relatively thin, and it looks to me like it probably needs to come in. I'd let this form a base and then look for some kind of a pocket pivot move. It just missed one here 4 days ago, but nothing really happened there, and it looks like it needs to move sideways. But meanwhile, the group here is kind of weak, and I'm not sure, is 3D, has it topped, or is it forming a new base? What's your take on 3D, Dr. K?
Well, we've got some pretty bad price volume action going through as it cuts through the 50-day. It had a gap down on earnings, and I have no interest in this except maybe as a short play, but certainly not on the long side.
Okay, so I know a lot of people, you can't borrow this thing, save your life, and a lot of people have been trying to short it, but you're not really getting any confirmation in the group per se. Stratasys, another one. You give it this one the same thumbs down as well, Dr. K?
Yeah, I mean, this whole group, I mean, it's just the price volume action is so negative. There's so much selling pressure that a lot of damage has been done. I need to see restoration of the technical action before I'm going to think about buying either of these names.
Right. So let me ask you then, given the context of the group, does this one become buyable at any point if it flashed a proper buy point?
Well, PRLB has been, you're talking about PRLB here. It's had the gap up on strong earnings, and then it undercut the low, but it looks pretty good. And again, I'd like to see some constructive action. It doesn't need to do as much constructive action to be convincing to me. In other words, maybe in the ensuing days or weeks, it has a pocket pivot after it gets more consolidated. Then I might be interested in this one.
Right.
It certainly doesn't look as bad as the other two.
Right. Michael Kors, it's trying to come down. It's testing its 50-day again. I thought this thing looked good on this outside reversal on strong volume, and then the next day it rolls over on heavy volume and breaks low. I actually bought some on this move on I guess it was Wednesday, and was selling it the very next day on a quick stop as it went through the low at 59.36, and it comes back down in here. But I don't know if this is going to be the place to be, if retail is going to be the place to be. Coors dumping a lot of supply into the market. Do you have any general take on Coors, or is it just the same old story of show me a buy point and maybe I'm interested first?
Yeah, exactly. I mean, there's nothing more to be said, really.
There's another stock that NXPI, which I've actually liked, and it's acted pretty well recently. These guys do some interesting things, basically a signal chip manufacturer, but they announced the second secondary in about the last month or so. They did a 30 million share secondary in early February, and then they just announced another one on Thursday, I believe, after the close, and the stock gaps down on heavy volume. I believe they completed it on Friday, but they didn't announce the price. They'll probably do that on tomorrow morning, Monday morning, before the open. So you get a chance to see how this thing reacts. But I get wary of stocks and companies that have two big secondary offerings, one right after the other. Even Coors, I think theirs were like 6 months apart, 5 or 6 months apart, whereas these guys are 1 month apart. And they're all insiders dumping, and none of the proceeds are going to the company. That kind of bothers me. You have a general take on that sort of activity, Dr. K?
Yeah, if you see too many secondaries, it makes me suspicious. But I mean, a secondary generally is a positive aspect to the company, and on the announcement of a secondary, the stock will drop, and that's often a buying point. But you want to see these secondaries spaced out a little bit less aggressively.
Yeah, and when they're doing that, you have to wonder. But these guys have some big numbers. Next quarter, 157% earnings growth. expected, and they seem to be doing well. Maybe that's what they're counting on. But I would just watch and see how this develops. If it is able to look strong, it's holding it in a range, and unlike Coors, which just falls apart every time they announce a secondary, this one held the lows of the flag here, the little base it's trying to form, and maybe this is a little more constructive, but we'll see. Everybody asks about this one, Everbank. It's a little small bank. I don't really care much for it. Next quarter's earnings, 7%, 3%. You had some big growth in the last quarter, I believe. Check some other sources. 44%, 48% in the last 2 quarters, according to O'Neill. But you broke out. You're pulling back. It doesn't really thrill me. How about you, Dr. K?
Yeah, these bank stocks generally put me to sleep, and it's looking okay. It's a slower name. The fundamentals look pretty good. Institutional sponsorship grows. If you like a slow, steady stock, this might be okay. It's pulling back. I don't know. It's just overall I'm not interested, but it's no cardinal sin if someone wants to take a position in this.
Right. And coming down to 16, I guess you'd come within range of the 1583 peak buy point in the base, which should be up here. So I think you'd probably hold coming into that, maybe the 10-day line, and I guess as it comes within range of this, I guess you can buy it, but it doesn't thrill me. Somebody asked about CF. Yeah, this is a failed base breakout attempt, so you break out here, you fail, huge volume on the sell-off. You're rallying up through the 200-day moving average. This isn't abnormal for this sort of breakdown. Notice how it breaks down sharply through the 50-day, breaks through the 200-day, undercuts the slow, and now is heading back up. Maybe it gets to the 50-day, and maybe it just forms a whole new base. I don't know, but it's I wouldn't short it here, and I certainly wouldn't go long the stock here. Somebody asked this question, Dr. K, do multiple gap ups in the NASDAQ index from the bottom of the rally, are they significant?
You mean like what the NASDAQ did in November of last year, where off the bottom?
Let's go. Let me check. Hold on. Let me.
19th, and then it had another mini gap up on November 23rd.
You mean here? I guess you do like a 1, 2, a little gap up here, another gap up here, another gap up here, another gap. Are they significant?
You want to see the volume on the day. On both of these, November 19th, the volume was less, and then on the 23rd, the volume was less. So it's more important to see confirming volume action rather than a mini gap. That's why the model's looking at price volume action. It doesn't really pay attention or care about mini gaps. Gap up or gap down is pretty irrelevant. You need confirming volume.
Somebody asked about this MX Magnachip, not a stock we would be looking at. I know this big earnings turn here, I guess, at least what I'm looking at here. But I'm not sure what's going on here because O'Neill shows negative 42% growth, negative 71% growth. So wait a minute, I pulled up the wrong signal. No, 196 and 76. No, these are right. You're right. I don't know. It's a thin stock at huge numbers, but I'm not sure what's going on here. I'd have to look into it. It looks like they just make analog mixed signal ICs for flat panel displays in mobile devices. Not sure. The 12% of net earnings growth expected this year. You got some big numbers the last two. But what I would want to know is why on this breakout did you get whacked on volume? Any take here, Dr. K?
Yeah, I mean that's obviously on the technical action is big cause for concern. Even though it did seem to get support, closed mid-bar, bounced off its 50-day there, but now it's went under the 50. It really needs to heal up, and even when it does. It doesn't mean I'm going to get interested in it because you'll notice the overall pattern tends to undercut the 50-day routinely. So that makes me a bit nervous. It's a sloppy pattern, and it's also a small cap stock, so it carries that much additional risk. So I'd probably not get interested in this one. If I do, it's probably going to be not weeks but months from now.
Yeah, there's really nothing here that thrills me. Bring this in over here. Let's see. FLT, Fleet Core. Yeah, that was this actually very similar to Centaurus, and it went very tight sideways. This continued higher. They gapped down on the announcement of the secondary. but it seems to be holding the 10-day moving average pretty well so far, and it's actually done that, I think, now. Would you use this 10-day moving average here, Dr. K, as a stop?
Yeah, I mean, if
or
it's...
did you reset, or are you resetting
well,
here?
You reset on the gap up, so you can't count 7 weeks from there, and then if it obeys the 10-day for 7 weeks, then you use the 10-day as your selling guide.
Yeah, and I would also add that if you are long the stock here, and if you start resetting the count, you don't use a 50-day moving average, you use the low of the gap up day, I guess, as your ultimate stop.
Right. And since if it were to round trip and go all the way back down, generally if you trade for 6 days after the Buyable gap up and it heads back below the low, you would just sell it with really no ferocity because it should have made a move by then.
Yeah, I'd also point out here, you got the same old upside trend channel breakout. Oh, sell that. So you'd be missing 10% here. But again, the need for labeling as a heuristic method. I think that's the chapter in our book. Is that right, Dr. K?
Yeah, we talk about that exact concept about labeling as training wheels is okay, but eventually lose the training wheels because they're going to eventually trip you up, and you might not spot the proper context in which the stock is showing itself by forcing a label onto that stock. Yeah.
Please consider commenting on IBD leaderboard leaders near buy point. I don't really watch IBD leaderboard leaders, so sorry. But we did comment on the 3 stocks: Commvault, so Evergreen Financial. I keep wanting to say Everclear for those of you from Texas. You know what I'm talking about. I'm in Silica from high teens. Oh, I feel so sorry for you. Any critique of Silica and its action? High short interest, small float. My intent is to hold for larger gains. No, seriously though, I'm glad to know somebody's making some decent money on this puppy. It's erratic stock, and this sort of weird breakdown up here. Maybe that helps to set up the move higher in the breakout, which was a Buyable gap up, and that did hold, did it not, Dr. K? Yeah, it did hold, but funky move. And it looks like it's stalling on the way up, but so far looking good. I would say the only thing you're doing now, Dr. K, if you own this stock, what would get you out?
Well, I mean, basically, either it comes all the way back in, undercutting the gap up day. I mean, that's a good 20. Looks like 20% away. 20% away.
So you give up a good gain.
That'd be about it. I mean, it might be volatile, but I'd try to hang on to it because it's doing the right thing so far.
Yeah, I mean, there's nothing really you have to think about if you're willing to give it some room and let it pull in. I know that people who bought Krispy Kreme, and we talked about Buyable gap ups down in here, this thing is broken out again. And Dr. K, I think you said this was a sell the other day, but I guess
I don't like this stock. It's been good for the first time in years. It used to undercut its 50-day, and now it's taken on new character. So it's good to take note of that. That Buyable gap up on the earnings report on November 20th. These Buyable gap ups sometimes will completely change the character of a stock, which is why I love Buyable gap ups in the right context. And certainly this one has it was trading under $10 on the Buyable gap up, and it's a small cap, and it's in retail, and the history of it is pretty negative. So I didn't trust that Buyable gap up. I still wouldn't because it hadn't really proven itself. And then it gets very tight in December, and then moves to new highs in January, and goes in this nice little uptrend. So now the character, it's expressing a different character. I'm still skeptical on this thing, but it's now traded for over 3 months with a different character. So basically, if I had to buy this name, I would probably start trusting it on March 4th, which is just a few days ago.
Right.
It had a move to new highs on appreciable volume.
Yeah.
But prior to that, it would be just too premature. I've seen many of these names. They look like they're going to change character, but they don't. They just go back into their very sloppy ways.
Yeah, well, I pulled in Homer Simpson as a consultant on this one, and down here is the first buy point, I thought, and you know, it goes up to 12, and you think you're so smart taking a 20% profit, and it looked good for a little while, like, okay, that was the right move. It went a little higher, and now it's breaking out and going even higher. But it's just one of your, I think, your typical turnaround situation where you have a stock growing earnings very slowly, even on the Reuters estimates here that you see. 71%, 16% this prior quarter. I think O'Neill's showing 100%, but sales growth is only 8% in the most recent quarter. Next quarter's estimate is showing 100% on first call, but Reuters is showing 83+%. Quarter after that, 87%. And you can see the little chart of the earnings, and then the dotted line are the estimates. You can see that revenue and earnings per share have just continued to trend higher, and they're looking to continue doing that. So it is a turnaround situation. But I got to admit, I was pretty skeptical of it too. But, you know, like I always like to say, the stocks that you think don't have much potential are the ones that end up doing that. And so that's why sometimes I look at this one and think, oh, this thing's going to end up going to 30 pretty soon, just because I don't like it, and neither does Dr. K. Winnebago, I'm actually surprised that this stock is doing as well as it is. They must be doing something different. Earnings growth in the most recent quarter was 550%, and you're looking at over 600% next quarter. That slows down. Let's look at a weekly chart here. Whoops, something happened here. Well, fix it right now. You're breaking out of a base. You're extended from the base, but you know, well, not much to say at this point other than that you just broke out. And if you look at, say, 20, let's look at the daily chart again. Say you figure 20 is a breakout point, you're extended from there, and you'd have to pull into like below 21 for it to become viable. This is another one of those situations that I would look at and say, oh, this thing has no chance of going higher, and it will end up going higher. So, not a bad name. Soda. I always look at this one in terms of its longer term chart. All it's doing right now looks like it's building a base, but it's trying to come up from this ugly pattern, so there's probably still some overhead. I don't know, maybe not. Some big volume down weeks in the pattern. This is a little bit of support here, but now you're flirting with the 10-week moving average. On the daily chart, you're just above the 10-week moving average. The 10-day is starting to turn back up. Maybe it's just building a base, but nothing really concrete in the way of buy signals yet. I think Amazon is interesting, and I'm glad someone, I'll try and type it correctly here. I'm glad someone mentioned this. I'm thinking about buying this one maybe tomorrow. I was trying to short it in here, and what I noticed is every time it broke down, it would find a bid, and somebody is in there buying it, because I noticed as it was coming down, you see it's closing off the lows here. You can see these charts show the opening tick on this side and the closing tick on the right side, so you can see it's kind of like a candlestick, but you can see that it's getting support. So I'd actually turn around and go long the thing in here and get a quick trade. As it breaks out, it stalls out and holds in real tight, and the volume is drying up, so it looks like it wants to go higher. But one thing I noticed, and this is something to watch out for when you're shorting a stock, if it looks like it's going to break, and of course you look at this action, this huge weekly breakdown to the 10-week moving average, but notice how you get a series of supporting weeks and it starts to close very tight. And I think this is the pattern. Well, the way we'll pick this up is you see the tightness, and then you might see a pocket pivot buy point show up, and I'll get back to the daily chart in just a second here to talk about that. But it's getting very tight, and so you're in the risk position if you're still trying to hit this. If you got to be looking at these on a weekly chart and notice you're getting support, and there isn't a lot of real heavy selling volume coming in after this breakdown following earnings, and you just came right back to the top of this pattern. And on a weekly basis, you're able to close above the 10-week moving average throughout these spin-out weeks over here, and now you've moved up higher out of it. I think Amazon's story is mostly a forward-looking story. You notice they're going to go to positive earnings in 2 quarters. 2,100% earnings growth, and I think the story here is more having to do with their cloud services, or AWS, Amazon Web Services, which they're slowly seeping into this area, and they have a lot of leverage there. And I've heard talk that they'll be able to take out Akamai in their little space and in other areas as well, and they're beating out Rackspace in the same area, and and there's been some talk that Amazon may buy them. I don't think Amazon needs to buy anybody. They've got a good enough infrastructure built up on their own. But you can see this just coming up and out of there after it tightens up. So you got to watch for something like that. And a lot of times that can tell you it's bullish action, especially if you're trying to short the stock. And I've had several instances where I've tried to short a stock, and if you're shorting it, you know, I like to think of myself as an old tape reader back when we used to have things that acted more like tapes, but now they're just kind of spinning little dials of decimalization activity. But you can look at the charts and you can see what's going on, and the stock comes up. And this is actually, I believe, you just cleared enough volume here for a pocket pivot on this day. And so this would be a little like a pocket pivot breakout from the low part of the range here. And this is one of those square box patterns I think that O'Neill talks about now. But we'll pick these up as pocket pivots ourselves. But you're going in real tight. It looks like it wants to go higher. If the market goes higher, this probably will go to new highs. So I think it's even buyable right here, and you'd probably use the 270 level or maybe the 10-day somewhere as a reasonable stop. But that's like 2 or 3% away. So if you want to keep a tight stop on it, that would be a good way to do it. You could watch for a spin out. The stock will tend to pull down, but when it does, it gets a bid in there. And I also would point out, you know, on the short side, just getting back to this idea. What's the matter? You don't like Lulu? Let's try it again. There we go. I've looked at Lulu, we talked about in prior webinars, as a short, but notice how it too has gotten tight along the lows here. And you know, I'd be cautious here. Obviously, it's back above the 10-week moving average here. And above the 50-day here. And so I'm not so sure I'd want to be shorting this necessarily unless I saw a breakdown and the market's breaking down. But this all gets back to the whole primary principle of shorting, which is you don't want to short in a bull market. And if we're in an uptrend, your odds of making money on the short side are less. And let me just quickly segue into Apple, which just bounced very light volume, bounced up to the 10-day moving average and the back to the point of this downside breakout. Now, I think if the market were to pull back, even in a short-term correction of a couple percent, 3%, you may see Apple break to lower lows. But Apple looks pretty darn ugly at this point. And on a weekly chart, you can see that. Let me pull out my annotation tools. You're coming down on top of this this area, this base, and it's trying to find some support on top of it. And I think, you know, if it rallied back up into the 10-week, that may become another shortable zone. So it's kind of sitting on the fence here, and I think a lot of that may have to do with the general market. But I got to tell you, Apple looks pretty weak, and it's in a downtrend until further notice. And my expectation would be that, as always, a body in motion remains in motion, and therefore this stock is in a downtrend, and the best that it could probably muster would be a rally back up into the 460 area on a logical bounce to the 10-week moving average. So for those of you always interested in Apple, fascinating example, though, I think, of a stock that it tops when everybody loves it. And the key for me was when it was trading around 700, having my younger brother over for dinner and his family over for dinner, and he works in an emergency room back in the town where we grew up in Whittier, California, and he was telling me all the doctors were deciding they were going to start buying Apple stock because they think it's a great company and a good investment. And when doctors start piling into something, with all apologies to you doctors out there, especially when you can discern that it's had a long run already, that's usually the top. So either that or I'm buying the product. So, you know, and everybody knows last August I bought my first iPhone. That's exactly when Apple topped. But moving on, let's look at Vail Resorts. I guess everybody's going skiing. These guys got big turnaround in numbers this next quarter, but then it kind of gets back to being a little bit ugly. I guess that's because, you know, spring quarter, you can see it's cyclical and probably is tied to snow, and that's all you got going on here. But not the type of thing that I would be buying into. How about you, Dr. K?
Nah, that's you know, it's not real exciting for me.
Maybe there's a story here we're missing.
You know, the earnings, there's a lot of red. Look at the sales, the earnings, there's a lot of defects in the fundamentals. So I'm not real interested in trying to gap down also on earnings a couple quarters ago. So
here's lumber liquidator, straight down, straight back up. You know, I guess this is a little funky and typical. A lot of these building related stocks, you saw, you know, EXP do this as well. straight down, straight up. I think U.S. gypsum, not so much, but they all broke down, and now they're starting to turn back up. I'm a little wary of this. There are no buy points in the pattern, so I just leave this alone. If you still own it, you briefly violated the 50-day, and of course it turned back to the upside right there. And this may be an example of why you might wait for the close on a stock that is a little thinner and a little bit more volatile. But straight down, straight back to new highs, that's a little cautionary. You'd want to see it sort of consolidate that. Would you agree there, Dr. K?
Yeah, that sounds about right to me. I mean, it's straight down, straight up. Yeah. So you got to watch the whole group too, and this group tends to like to correct as it moves higher.
Right.
It used to be stronger. Now it's I mean, just be careful with this one because it's and these retailers often do chop around, as this one has.
Yeah, and Home Depot, another one. Here's a big, I guess you might call this a pocket pivot type move. It's sort of a shakeout and a breakout, and it moves higher, but there are no new buy points. So, AMBA, this is one I've never heard of. Must be a biotech. Ambarella. Let's see. Nope, it's a fabless semiconductor company. Next quarter earnings, negative 21% is estimated. The stock had a gap up. Would you call that a buyable gap up? Would you be interested in this, Dr. K?
Well, the fundamentals are looking all right.
Very thin stock, though. Very thin.
It's the problem, and it's a low price. It's low price thin name. It's a mini cap. It's not even a small cap. So just on that basis, I probably wouldn't be so interested. There's just too much risk in these types
That means it's going to double from here, so you should buy it tomorrow.
Very well could. Very well could.
I'm looking at it, I'm like, I'm not that excited either. CME broke out. The only problem with CME is that it's got negative earnings growth. That's the reason why we've blown it off, rather. Let's see. Somebody's asking a question. I'm going down the list here of IMs coming in from you guys, so I'm about halfway down the list right now of questions. So we're going to try and move through these. We're already about I'm going to say 50 minutes, maybe a little less into the webinar. But we'll go maybe 15 minutes beyond today just because it's the weekend and I have nothing better to do than look at charts all day. Let's see, when the market went into correction recently with so many stocks breaking through the 50-day moving average, would that have been a time to overlook the 7-week rule and sell holdings such as LinkedIn? Would have been correct to hold instead? I think that all depends on your risk preferences. If the market's breaking down, they're going to take a lot of leaders out. It really depends on where you entered the stock. If you have a small profit in a position, you might want to take some of it. I think you'll have another buy point in LinkedIn showing up, so it doesn't really bother me in terms of whether one sells. I think it depends on where you came in. So if you're like a maniac and you take like a 50% position like I might in my own account going into earnings and then it gaps up, well, you've got a good profit. If you're taking a smaller position and you come in on the gap up or say come in later, somewhere in here, then as you're coming in, your profit is at risk, and so you may just be better off backing away. It really depends on what your risk profile is, and we have some accounts that we run where we try, our number one rule is never lose money or try not to ever lose money in stocks, and so we run that very tight. In my own account, I'm willing to take 20-30% downside hit. That doesn't bother me. That's just the way I trade, and so I may be very aggressive here even into earnings and not be afraid of it breaking down. And you could be holding, but another way to operate is if you do have a big position that you took and you have a big profit and the market starts to break, then you can lock it in and then come back and just turn around and buy the stock. And I'll do that if I have a prior cushion in the position. So I think once you have a cushion, it gives you a lot of flexibility in terms of what you want to do, because the key here is what is going to be the next leg up on this stock. And I think, as we said, this is your initial break through the line of least resistance. You're moving up. Notice the weekly volume is declining. You're getting close to a spot where you should see some kind of a pullback. Doesn't mean you're going to, but that would offer a better entry point and give you a better sense of where this thing is headed from here, because this is just a first stage breakout. So hope that answers the question. But there's a lot of different approaches one takes based on risk profile, and I think that's the key point. I learned that running a hedge fund the way I would run my personal account is great on the upside, but when you have a pullback, people freak out, and they think something's wrong and want to start going off on you, and that makes it difficult to run that sort of money. So I only do that sort of stuff in my own account these days. Dr. K, these two old-fashioned concepts. One, we're 4 years into this bull market. That's due for a top. And two, big caps, not small caps, take the lead in the late stages of a bull market. Do those ideas have any relevance right now? Do you give them any thought? Has QE changed all of that? Did you get that?
QE's changed all of that. QE's changed a lot of things, and a lot of the tried and true things that we used to work over the decades don't work since 2009. So given that, I'm really not paying too much attention to some of these old rules about big cap stocks putting the final finish on an extended bull market, and also bull market age is also thrown out the window, because with QE at the helm, these bull markets can run a lot longer than we think. And that goes true for a lot of other bull markets. So we'll remember the late 90s. In 1997, Greenspan said the markets were too high, but it was still another 3 years of one of the most powerful bull markets before that bull market actually topped. So it's really important to just stay focused on the present and not get too hung up on some of these rules that may have worked for a number of market cycles. I think that's a very important lesson, because markets will change, and that's why the model does change with any inherent change that's material that proves itself over a period of months. The model will adapt to it, because it has to. The markets will never ever stay static. They never have stayed static, but there are things that will outlast other variables, and that makes it interesting. In other words, there's never a dull moment, and there's no such thing as a black box, and that means you always have to keep on your toes when it comes to this sort of thing.
Yeah, and I think those are labels. Label market in 4-year bull equals top. That's a label. So I don't think we need to rely on labels. I think we just need to rely on price volume action ultimately. So inner workings. This is just a small, thin little stock. Barely trades a couple 100,000 a day. Decent earnings, sales growth 19%. Sponsorship is declining over the last quarter. You do get a little breakout here on the weekly chart. No real volume. Let's look at daily. So just a breakout. So you're within range of it. So it doesn't strike me as anything that's all that exciting. So airlines, rental cars, Priceline, etc. seem to be moving. This is true. So is Trip. It's moving higher, breaking out of this big giant cup with handle. Was kind of looking like it might be a failed sort of a pod type formation, but that ain't happening, and it's breaking out. So you're seeing that Priceline is moving higher, and it looks like it's trying to break out of a cup with a handle pattern. You get some big support here on this week. You also have car continuing to move higher. This is the one that we didn't like, somewhere down, I think down in the 18 range, and of course you can see this one's gone higher. So again, it just points back to if you have a sort of a built-in internal bias against certain names, and in this environment, one of my big biases is negative earnings or negative earnings growth, but in some cases that hasn't prevented stocks from going higher, and it's one of those markets where you see that happening. And I think 2003 was similar to that. But you have a nice 3 weeks of tight closes here with support off the lows of the weekly range, and then it moves higher. So it's a 3 weeks tight breakout, I guess you would say that is. What was Avis? We're number 2. We try harder. Was it AVS? No, I forget. Somebody hit me with the Avis. What's the Avis symbol, you guys? Somebody hit me with that card. Thank you. Send that man a prize, or that woman, whoever it is. I'll have to check that. But here's another one. You get a lot of supporting weeks in the pattern, and it breaks out. And this is another one I never really cared for. But whoops, what happened there? Something got in there. Yeah, here's your breakout. So you're theoretically within range of the breakout, holding in very tight. Looks like it wants to go higher, but I hate the stock, and it hates me because I haven't bought it, I suppose. Air Lease, somebody's asking about. The airlines have been acting well. These continue higher. Earnings growth has been decent, so nothing really wrong there. They've been working, but not stocks that we've been looking at, probably just because we have a bias against them. They don't strike you as being all that exciting, but starting to have a move. You have a big volume pocket pivot here, so Is it within range? I'd rather see it test, do a little pullback close to the 10-day moving average if I was going to step into this pocket pivot. But that's what that is. Alaska Airlines is another one, and you're seeing same thing here. It just doesn't make a lot of sense that these companies would be doing so well with the consumer supposedly having trouble. But the one thing I did notice, you had a big jump in consumer debt announced this past week. So, you know, the bubble continues. People are going back to using debt and getting further into debt, and just like the government. So let's see. Netflix is going tight sideways and not really too much there. Now, someone was asking me if this was a pod, but again, go back to our first book, and what was the short selling chapter, Dr. K? Chapter 6, I think it was, where a pod is basically the whole concept of a punch bowl of death, where a stock breaks down, 50% or so, and then turns right back around and goes back up to highs, is that it's a very sharp and quick move. So let's say if Netflix had gone straight back up here, and generally these things will take place between 20-30 weeks, give or take a few weeks, and that's what happens is a sharp move back up is unsustainable because it's just too quick, and there's no time for it to work off some of the weaker hands, and then they come in and hit it as it comes back to highs. But Netflix is just up in a high tide flag from this position. You know, I'm hearing a lot of good things about a turnaround here, and that may be true. And so right now you're in a tight formation, and I would just watch this. I think there's probably, let's check the short interest on this one. Doesn't have high short interest, Dr. K. It's 1.5 days, which isn't very much, less than 10 million shares on a 53 million share float. So there's a few shorts in there, but this thing's just moving tight sideways. To me, it looks like it wants to go higher, and I've been keeping an eye on it. I remember this breakout or this move here, and I watched the stock jack after hours, and I was thinking I should just buy some shares right here around the 138 level, and sure enough, I didn't. And it goes higher. But now you may get another chance to buy this. It's a turnaround, and you can see they're going to go to positive earnings growth in the next 2 quarters, and that doesn't look bad to me. So somebody says, sorry if this has been asked. I came in late. In general, what are we looking for overall in a market top? Well, you know, breakdown, so lower lows, and you're not seeing that yet. You're seeing higher highs, so that's what you're looking for. Would you agree that money is flowing out of bonds and into stocks? Paper money is devaluing. Stocks making money have to increase in price to maintain their value. That's a good point because obviously a company like, say, IBM or just name any company, they're not going to go down 80% in value just because the dollar goes down in 80% in value. They're going to have to go up in nominal terms to compensate for that drop in volume, and I think that that could happen. You know. Anyways, some other stocks. I'm gonna try and run through these as fast as possible. Variant is just in a flat base, so you've got no pocket pivot action in here yet, but it is a little breakout here, just barely coming out. So. Earnings up 7% in the last quarter. So on that basis, I would overlook that. AMRI. Oops. Albany Molecular Research is just extended. You know, you had a buy point here off the 10-day moving average. This must be another one of these. It's an interesting little stock. It's just kind of thin for me right now. I think if it's any good, it'll form another flag up here. But if you look at the weekly chart, it's sort of coming up out of this one of these sort of patterns. Well, probably went a little too far. So that's what you got going on here. You're susceptible, I think, to hitting some overhead on this side, maybe, but that's a long time ago. So that's not really clear. But let's see. VeriSign. It's this big, deep, on the weekly chart, this big, deep, double bottom type cup with a handle thing. This thing was looking pretty ugly back then. It was looking like it was forming a head and shoulders and going to break down, and it did actually break down through this head and shoulders here and undercut and then turn around and rally. But I'm not a buyer of the stock in here, so don't really care for the gap down. Agree or disagree, Dr. K? Yes or no?
Do not like the gap down. Never do.
Blackstone Group, you got a little pocket pivot here on a breakout, but you know, looks okay. I think BlackRock is looking similar. But these are private equity companies. Let's see. APO. This is one that's looked interesting. Getting choppy up here, though, but nothing really. It's another company like Blackstone, BlackRock, whatever they're called. The Blackstone Group, and you got BLK, and you got APO. These are all investment management companies, private equity firms, whatnot. And they've had big moves, but there's no real breakdown in any of these yet. ABAX, Abaxis, this is a little breakout from a little flag formation. Not bad. Earnings look okay. In the most recent quarter, up 69%. Sales were up 32%, so that's not too bad. Next quarter, you're looking for 24% earnings growth. So that doesn't look that bad. The reason it doesn't hit my radar is because it only trades 146,000 shares a day. So a thin little stock, but it's moving, and you do have a buy point. GWRE is Guidewire. I've been looking at this one, but I don't really see it in the numbers, for me at least. Earnings growth in the last quarter was 40%. It's only one quarter up. Sales up 31%. Next quarter, negative 69% growth on 3 cents. Don't really like that. Prior to that, you had 3 quarters of negative earnings, but it is breaking out of a a base here. Let me, whoops, going the wrong way. Sort of a big ladle with a handle here and breaking out here. Maybe this was actually the breakout point in here, but now going to new highs. So it's acting well, but the earnings aren't really there for me, so I'm not sure what's going on here. Your COO, a Buyable gap up, Dr. K. Let me pull up the daily chart.
Let's see.
Is that the daily chart? That's not a gap up, though. That's the problem.
There's no gap up. I mean, it's gotten tight in the pattern, and it had a good earnings report, so it's issued a pocket pivot. However, this stock, you'll notice it breaks through the 50-day route regularly, so it doesn't appeal to me. If you also look at the earnings and sales, the numbers are pretty anemic.
Yeah.
So this stock has a lot of flaws. I'd avoid it.
Quick review on gold and silver. There's really nothing to say here other than that they're trying to hold long-term support levels, and that's really all that's going on. So we don't see any buy points. We're not going to necessarily bottom fish in here. Physical markets are still relatively tight. If you want to find out, just go in and try to buy 1 million ounces of gold, and you will have a hard time finding it. But the metals, the paper metals, vehicles like the SLV and the GLD, they're in these downtrend channels and maybe getting close to a low where you're going to see a rally up and out of here. I don't know, but you are getting to the lows of the consolidation, so we'll have to see. Dr. K, since the inception of QE, has wedging up on weak volume become a less useful concept/tool to analyze charts? Quickly.
Well, individual stocks wedging is still bearish, but if you're looking at indices, then yeah, I mean it does throw a wrench into this. You can see it. We've seen examples of indices that were moving up on anemic volume and then continued to move up on anemic volume. And that's because the QE put in a floor, and the law also offered some fuel in the form of fumes to push these markets higher.
Yeah, and I think these days you're probably looking at there may be also an allocation trade going on. People say there isn't, or there isn't. There's a lot of debate, but I noticed you look at the Barclays 20-year plus Treasury bond ETF is breaking down last week pretty hard. And just kind of blew apart. So interest rates rising on the longer end. So I think that could be you could be seeing a movement out of bonds and into stocks. So my friends who are retail brokers who sell people bonds all the time, which I think buying bonds from a retail broker is just a great way to get hosed. But they're always telling me, oh, the bond market's okay. I think loading up your clients on bonds these days is not going to turn out to be a very smart move in the longer run. But let's see, price line, were we looking at this on a daily chart going tighter? We already talked about this one. Google also, the stock Dr. K loves to hate, but it's continued to go higher. But keep in mind also is that on a percentage basis, you know, $76 stock, $75 stock going to 83, which is not a bad move, but it's not like it's a rip-roaring mover. It looks like it's moving more than it is because of the number of points, but again, percentages matter. This is a gap-up type move. It's got the characteristics, I think, for a Buyable gap-up, but the bottom line is stock's in an uptrend. You're holding in very tight, and it just looks like it wants to go higher. I read this past weekend that Google has replaced Apple as the #1 holding in mutual fund portfolios. Catamaran is another one of these funky stocks that we're always asked about, but we don't really care much for it. It just acts too funky. MNTX is that pattern. It's trying to rebuild, I guess, but it's not even a stock I would be looking at. $10 stock, too cheap. But earnings are turning around, up 133% in the most recent quarter. Next quarter's estimates are for 78%. It looks like the O'Neill numbers jive with this one almost exactly. So you've had a good turnaround in earnings. It's a cheap stock, but is that a normal pullback? It runs into resistance here. I mean, if you're going to do technical analysis 101, pulling back to the 10-day, but you got this breakdown here, which doesn't look so hot. I'm neither here nor there on this one. Somebody says they like the weekend webinar. I like them too. It's a little more leisurely, and I don't have to worry about trying to watch the market at the same time, so that is helpful. Dr. K, volume tells you conviction or strength of a move, right? Since the inception of Q, has volume as a measure of conviction been lessened? I think you've seen volume come in at certain times, and it's confirmed the rally. So I don't, trying to get into this labeling volume as influence as being lessened or not is irrelevant to just deciphering where the trend is. Dr. K?
Yeah, exactly. I mean, the volume is still a valuable tool, and but QE does have its place, and you can take that QE into context when you are looking at certain patterns in indices.
Solar Winds is trying to guess. It looks just offhand. It's trying to come out of this pattern, but this has been a funky stock. I've never really cared for it. I'd have to understand more about what's going on with the company, but it's just trying to move higher with the market. So earnings growth 23%, kind of tepid over the last couple of quarters, but it's trying to come out of this base that it's in. But I'm not really sure. 77 relative strength, even though it's moving to new highs, so that doesn't really throw me. Someone's asking me if I'm fooling with any ETFs right now. No, I'm not. But that can change. Someone says it seems the consumer is traveling more. Someone says they are, so that may be so. I don't know. Baidu has a short sale. It is trying to break down, and you saw volume pick up marginally on Friday, and it looks like it's breaking down, holding along these lows. Yeah, I suppose if you saw a downside breakout, this would become shortable, and it looks kind of shortable. It looks weak, like it wants to go lower. So if the market did roll over, you might try going after that on the short side. Let's see, some other questions. Jazz Pharmaceuticals. These guys are coming out looking like they're going to start another move. They got a long base, so they're trying to come out. You got some nice volume the last couple of weeks, but you stalled a little bit last week. You can see this stalling here. And it looks okay. It doesn't look bad. I mean, a lot of the biotechs have been improving. Of course, we own Celgene, so we like that one. And I think Biogen also has been doing well. And we own Centaurus, and that's actually a medical ethical drug company, but it's kind of a biotech as well, given that they have this proton pump technology. But that comes out of a nice tight weekly pattern as well. So I think the group looks pretty good. So I think most stocks in the group, including Jazz, look good. So you pick the strongest one out of those. Somebody says on the NASDAQ Weekly, it looks like, let's go to the NASDAQ Weekly. Here's the NASDAQ. It looks like more distribution than accumulation. Well, what I'm talking about here is if you look at the weekly ranges, these two weekly ranges, and these were the last couple of weeks when we saw the market get hit pretty well and the market direction model went to a sell signal. And I think a number of other people's models went to a sell signal. I mean, that action was so almost obviously bearish that maybe that was the problem. But my point here is that you're closing up well off the lows and in the upper half of the range. So it's really telling you as volume picks up on the second break that there's a bid stepping in there. And I think that that looks strong. If a stock were doing that and then broke out like that, that would be very constructive. So I don't see that on a weekly basis that there's distribution. On a daily basis, you're not really seeing any heavy-duty distribution either. So did I actually show the right chart there? Let's go to the weekly chart. Same thing. You know, the NASDAQ actually closed up last week and 2 weeks ago rather, and closed well up in the upper part of the range. So that's really the key, is the support off the lows. Somebody's asking about Visa. Whoop! I got to switch over to all securities here. They package everything in this program on in different, you know, the all securities. You know, big caps, small caps. You can look at various index components and break them down. And they pretty much have them all broken down for you. And it's one of the things I like about this. It's very easy to use that way. Visa is just forming a base, so it looks like it's, you know, trying to set up for something. No pocket pivots or anything, but it looks like after this long base, it wants to go higher. You know, 12% grower in the next quarter, so it doesn't really thrill me. I'm going to get to some more questions. OAS, yeah, I think I like Continental Resources better, and Bonanza Creek Energy. CVRR long, no, I don't like this pattern. Looks pretty ugly. Choppy, ugly. These guys have any earnings, Dr. K? It's really a recent IPO. I'm not really seeing anything here. Let's see. Wait a minute.
There's not a lot of data on this thing.
It's refining. You know, refining's been one of the strong groups.
It's a triple-digit earnings gain, and then I don't know if these numbers are right, because it's sometimes they enter the data and then they readjust it. But yeah, it looks like the numbers are pretty powerful. The industry group is sound. You know, ninth. Sales are quite strong. But you know, it's an oil company. So I'm always skeptical on these because they tend to take 2 steps forward and 1.5 steps back. Yeah. We're getting a lot of votes for continuing with weekend webinars. Somebody says here, good prep to think about the week ahead. Yeah, and somebody says, aren't you going to show us your weekly routine? This kind of is our weekly routine. I just kind of hammer through a bunch of names showing up on the list, but I'll just show you real quickly as we close up here. Last couple of questions. Expedia is hanging in there. Slow earnings grower. There's probably better name. Whoop! I don't know what just happened there. There we go. Slow earnings grower. You had a little kind of I think pocket pivot sort of gap up move here, but it's not going anywhere. I mean, it's okay. SunPower. I'm not really a fan of the solars. So First Solar is another one. It looks to me like it's going to head lower. It looks like a short almost. And you have to remember where these are coming from in their overall patterns. And there's another thing I like about this. You can see that's where First Solar is in its overall pattern. That looks pretty darn ugly. SunPower or Spewer, you're in a sort of a flag formation. And maybe it's in a little better position higher up in its overall pattern, I think. But wait a minute. Let me actually, if I drop this down. No, yeah, I mean, that's where you are. These are, I don't know. I'm not into them. Now, I mean, all I do, and I can use any program, is everybody's always asking me, you know, what are your screens? How many screens do you run? What criteria do you screen on? I just keep my own lists here, and I like to look at every stock with a composite rating over 85 that trades more than 350,000 shares a day. And so this is the list this week. And all I'm doing here, and I'll show you exactly what I do, look at them in two views. First I go through weeklies. So just do this. You know, in a lot of these stocks, if you just flip them, this Alon Partners, I think there's another refinery company. Whoops. There's some Amgen, you know, gaps out of there on a weekly basis. Amphenol is showing up there. I mean, these stocks all look pretty good, and so I'm just kind of ripping through these. I can blow up the charts if I want to get a better look at the weekly charts. And just going through these, and anything that catches my eye,
I'll go into more depth on. You can go over to your MarketSmith or whatever other tools that you use and get more detail on it and different numbers and just kind of contrast and compare. And there's a lot of what I would consider doggy stocks as well, but there's these are the stocks that have the better composite ratings. And again, I want to remind you that back when I was at O'Neill, I think it was in 2004, that's when the composite rating was first developed. And the reason it was developed was to provide a guide for sort of overriding lower numbers like lower EPS or lower relative strength, because there are a lot of stocks that will show a lower relative strength number or a lower earnings per share number but have a very high composite rating, and you can see that. And so that's one of the reasons I like looking at a list of stocks that are better than or greater than 85 composite rating. Celgene, Cerner Corporation, another one that looks interesting. Chicago Bridge and Iron coming out of a 3-week tight pattern, looks very interesting. Church and Dwight forming a little base, and so I just kind of ripped through this. Here's Commvault, shows up here. This is the index. So this HGS Investor Software will also create an index of the list that you're looking at. So in this case, this is my list: composite rating greater than or equal to or greater than 85. And they'll keep track of it. And you can kind of compare how your little group of stocks is performing relative to the market. I know some people who use that to compare how the leaders are acting versus the general market and so on by having an index created of a list of names. So this is actually an index of all stocks right now that have a composite rating greater than or equal to 85. And that's what I'll do there. And then after I've gone through them on a weekly basis, this looks interesting. Core Laboratories, kind of a tight pattern in there. Earnings kind of stink, but you can also go back to another program you have, like MarketSmith, for example. We use Wanda, and we use that quite a bit. I use it in conjunction with this program. And you just rip through this and just looking at names, and that's what you're doing. Getting your elbows all greasy there. And then you switch to daily view, and it gets you a little more where you drill down. Or if you want to get real tricky, you can put a couple of chart windows up, one a daily, one a weekly, and kind of rip through those. And now we're looking at daily charts, so just going through a number of these. That's basically what I do. It's not rocket science, and I think what happens over the years is it's not so much the screens you use, it's not so much the techniques per se, or the criteria that you're looking for, the way you rank stocks, or all this stuff. You develop an eye over years of looking at a lot of charts, and I think it's just experience that figures in. Sometimes the experience can work against you because it locks in rigid views of what the market might be like. And I would have to say, from my own perspective, having come into the markets as a stockbroker in 1991 when I started in the business, you had a parabolic decade in the 90s, and I became so conditioned to that the 2000s have been more difficult in terms of adjusting psychology to what's really happening. So your experience in that regard, if you allow it to rule your thinking too much in terms of, well, I've seen this in the past and that's all that's possible, that can cause you to miss a lot of things. And I think a lot of old-timers who grew up during the 70s and 80s, by the time the 90s rolled around, they just couldn't cope with it. Because I remember hearing many times from old-timers, both at Merrill Lynch, Payne Weber, and even at William O'Neill and Company, old-timers saying, well, this market's, it can't go any higher. This is crazy. This is out of control. This is just a big bubble. And yeah, they turn out that way, but in the meantime, you make a lot of money. So how about using the Growth 250? I don't know what that is. Maybe that might be an HGS investor list. They actually have a bunch of other lists, and I should also point out in closing before we end the webinar, they have, let's see, HGS reference groups. So let's look at, no, wait a minute. What am I looking at here? Let's go here. HGS strategies, Morales and Catcher, trade like an O'Neill disciple. And you got pocket pivots, and other things going on here. I think they're going to be adding a Buyable gap up module pretty soon. But you can look at, let's go to all security. So let's just take a stock like, see, pocket pivots are immediately highlighted in blue. So not every single one. They're basically, it's raw. They're using raw criteria. because you can see these are extended from the 10-day moving average, the pinkish line. This one's a little bit better here, and but it helps you identify these very quickly. So we've worked with HGS Investor Software. I will be presenting at their conference, which is going to be held, I believe, on March 22nd through 24th, which is a couple of weeks from now. I think I'll be presenting on Sunday, probably talking about Buyable gap-ups this time around, because they are rolling out a new Buyable gap-up filter, chart filter, so you can actually see them on the chart, just kind of highlighted for you. And I think it's at the Marriott in either El Segundo or Palos Verdes, I forget. But you can go on their website. I think it's highgrowthstock.com. And there are a lot of things that are similar, but High Growth Stock Investor, a lot of it was derived from O'Neill style investing. I think Ron Brown, Ian Woodward are very smart guys, and I love their work, and I love Ian. He's just quite a character, and I think everybody should go to their conference at least once in their life. In any case, that's really all we have, and you get a sense of, that's basically what we do on the weekend. It's just, a lot of it is just elbow grease, understanding stories, going on the Internet. I mean, the Internet's a great tool that we didn't have when we started in this business in the early 90s, and you have it now, and it allows you to just gather up all kinds of great data and information about what's going on at companies. So that's really what it's all about. Dr. K, would you say that same thing?
Yeah, just keep burning the midnight oil, stay focused, and be diligent. I know plenty of times with other traders, and myself included, where the market will disappoint and tire you out, and then you take your eye off the ball, and then you're going to miss the next big move. So try to maintain the discipline no matter what, through thick and thin.
Yeah, I mean, that's basically all it is. So there's no magic to it, no magic screens, no magic methods. You're using your typical risk preference or risk parameters in terms of cutting losses and whatnot, and just giving yourself a chance and trying to put yourself in the right place to get lucky. So there is some element of luck involved in the markets, but I think it's hard work that puts you in the position to benefit from luck rather than just sitting on the sidelines. So, that gets back to the old saying, you miss 100% of the shots you don't take. So you've always got to be in there taking shots and doing your homework. There's no magic. So that's that. That's all we've got. And thanks for showing up, you guys, for this rare weekend webinar. But maybe we'll do more of them, so you guys get a better view of what's going on. We'll see how that works out when Dr. K and I will talk about it. So anyways, everybody, thanks for showing up again, as always. Appreciate you taking time out from your busy weekend for this, and we'll talk to you all later.
So long, everyone.